Welcome to the Deep Dive. We have a bit of an unusual mission this week. We're taking this, huge stack of sources covering a really packed week of central bank news. Fed, ECB, BoC, all making decisions almost simultaneously. Our job is to distill this down, find the core insights for anyone tracking U.S. and European financial markets. We're looking squarely at those late October 2025 releases. We need to pull out the key policy impacts, what's driving currency pairs like USD, JPY, the context for U.S. stocks, and the general sentiment.
Yeah, this period, late October, it's absolutely pivotal. What the sources show is just how fractured the global picture is right now. You've got these central banks juggling three big, often conflicting things: sticky inflation, rising trade war risk, and frankly, pretty weak growth across the board. It's a real moment of divergence.
Yeah.
Getting the nuances right is, everything.
Okay, that's the task. Let's dive in and build that structured summary. Starting with, I suppose, the biggest headline grabber. The Fed's move. So the Federal Open Market Committee, the Fed, they met October 29th. And as expected, really, announced a 25 basis point rate cut. That brings the target range down to 3.34 to 4%.
Right. The cut itself wasn't a huge shock, but what's really interesting, illuminating even, is the why. The shift in priority you see in the official statement. They acknowledge inflation is still somewhat elevated, sure, but the decision to cut, it was explicitly driven by their view that downside risks to employment rose recently. That's a critical pivot. It shows them actively shifting focus towards heading off an employment downturn, even if inflation isn't quite back in its box.
And it wasn't just the rate cut, was it? There was also a significant move on the balance sheet side.
Exactly. That's the other key piece. They decided to wrap up the reduction of their securities holdings, that's quantitative tightening, or QT. They're stopping that as of December 1st.
Okay, so for listeners maybe not deep in the plumbing, what does stopping QT actually mean?
Well, it's basically a secondary, kind of subtle way of easing policy. The Fed stops actively shrinking its balance sheet. The thinking here, based on the sources, is that money markets, like the repo market, were showing some signs of stress, getting a bit tight. So by halting QT, the Fed's saying, okay, we think we've got the level of bank reserves about right now, trying to stabilize that crucial financial plumbing.
So if they've paused QT and cut rates, you'd think that signals a pretty clear path towards more easing. But then Chair Powell's comments afterwards sounded, hesitant. He stressed that another cut in December is, not a foregone conclusion. Far from it. Why such a strong caveat?
That really gets to the heart of the tension within the committee. The sources point to strongly differing views internally. You've got the growing evidence of employment risks on one hand, but on the other, you still have these upside inflation risks, often driven by things like tariffs, which are kind of outside the Fed's direct control. So Powell's managing expectations. He's essentially saying, look, we're watching the data. If employment risks ease up, the inflation fight comes right back to the forefront.
Okay, and speaking of those employment risks and trade issues, let's look north to Canada. They provide some really important global context here. The Bank of Canada also cut rates by 25 basis points on the same day, down to 2.25%.
Yeah, and the BoC's reasoning gives us maybe the clearest view of the structural damage from these ongoing trade disputes. They were very explicit, citing U.S. trade actions and the uncertainty, especially hitting sectors like autos, steel, lumber. So what here is crucial. Tariffs aren't just about prices. The BoC points out they cause structural damage, reducing the economy's productive capacity, and that limits what the central bank can do. You can't just boost demand with rate cuts if the economy can't actually produce as much efficiently anymore without sparking inflation. It's trade policy effectively handcuffing monetary policy.
Okay, let's shift gears across the Atlantic. While North America was cutting, Europe and Japan held their ground. The European Central Bank, the ECB, met and kept its key rates unchanged. The deposit facility rate stays at 2.00%.
Right, they held steady despite, pretty lackluster economic numbers. Q3 euro area GDP growth was just 0.2%. And Germany, the engine, was flat B.0% growth quarter on quarter. So I hold. It boils down to inflation still being sticky. The initial estimate for October inflation, the HICP reading, came in at 2.1% year on year.
Right, HICP, the Harmonized Index of Consumer Prices. That's the ECB's key metric.
Exactly. And digging into that number, the sources highlight that services inflation, the part often tied to domestic wages, the sticky part was actually the strongest component, up at 3.4%. That underlying domestic pressure makes it really hard for the ECB to ease much, even with a stagnant economy.
But didn't the Governing Council also signal a shift in their risk assessment? Something about downside growth risks having abated. That sounds a bit more optimistic.
It does sound optimistic, but you have to look at why they think risks abated, and it's almost entirely external, almost political. They specifically mentioned the EU-US trade deal, the ceasefire in the Middle East, and some progress in US-China trade talks. So the ECB is essentially saying, we're holding steady because these big geopolitical risks, the ones really crushing business confidence, seem to have eased off for now. It just underscores how much the Eurozone recovery depends not really on internal strength, but on things outside their control, like stable trade and geopolitics.
Okay, and then over in Asia, the Bank of Japan, the BoC, also holding steady, keeping their overnight call rate target at 0.5%. But that decision wasn't unanimous. It was a 7-2 vote. Why does that internal disagreement matter so much for the global picture?
That dissent is really significant. It signals that the patience Japan has shown on monetary policy might be reaching a breaking point for some. The two dissenters wanted a higher rate, 0.75%. And they explicitly mentioned a shift in the norm that prices do not rise and growing upside inflation risks. They think Japan is finally shaking off that decades-long deflationary mindset. Now, the official BoC view is that core CPI, which is currently running around 3%, will likely ease back below 2% next year. They see the current inflation, driven by wage pass-through and food prices, as temporary. So the majority is willing to look through 3% inflation today because they believe it will fade naturally without needing tighter policy. And that decision is what keeps the huge interest rate gap wide open compared to the rest of the world.
All right, let's bring it back to the U.S. and look at sentiment. This feeds into that fear and greed dynamic people watch. The Conference Board's Consumer Confidence Index dipped slightly in October, down to 94.6. What's the real story in those numbers?
Well, the headline number moving a bit isn't the main thing. The crucial part is the expectations index. That's the component measuring the short-term outlook. That fell to 71.5. And why that number matters is because it's been stuck below the critical 80 level, often seen as a recession warning threshold, since February 2025. That's 8 months of persistent pessimism about the future from consumers. That's a really big red flag suggesting underlying weakness, not just temporary jitters.
And what were the specific worries driving that pessimism beyond the usual inflation concerns?
The sources flagged a notable increase in mentions of U.S. politics. Specifically, the government shutdown was cited as a key concern. When consumers start worrying about political gridlock and whether the government can even function properly, it really puts a damper on their future spending plans. That feeds directly into that low expectations reading.
Okay, now let's talk U.S. equities. There's this huge narrative around tech and AI stocks driving the market. The Fed's rate cut is generally seen as positive for stocks, but Chair Powell's comments were kind of mixed, weren't they? He noted the boom in AI investment is supporting activity, which sounds good.
But then he immediately followed it with a pretty direct warning about financial stability. That might be one of the most provocative takeaways from the week. Powell explicitly said equity valuations by many metrics look stretched. He specifically raised the risk that if sentiment around this AI boom suddenly shifts, remember, it's the engine of current growth, it could lead to a sharp revaluation downwards.
You really have to grasp the paradox here. AI is supposed to boost productivity, which long-term should be good for growth, and maybe even deflationary. But the investment frenzy around AI today is driving these massive stock market gains. So the Fed is basically saying, yes, we see potential long-term benefits, but the price being paid right now in the form of high stock valuations, that's creating an immediate financial stability risk. It's a new kind of challenge for central banks managing the market froth that comes with potentially massive technological shift.
So let's pull all these threads together. The Fed cutting, BoC cutting, ECB, and BoC holding firm. What does this divergence mean for the big currency pairs? Let's start with EUR-ASD.
For EUR-USD, the core story should be the narrowing rate differential. The Fed cut, the ECB held. Structurally, that makes holding euros relatively more attractive than dollars. So that should support the euro, but, and this is a big but, it's a classic tug of war. You have the rate differential pulling one way, but pulling the other way is just stagnant Eurozone growth. Remember that 0.2% GDP and the ECB's own comments about manufacturing being hurt by a stronger euro. So if the euro actually strengthens too much because of the rate differential, the ECB might start talking it down or hint at easing, especially if that trade relief they mentioned doesn't last. For now, that sluggish growth is probably putting a cap on any major euro rally, kind of counteracting the Fed's cut effect.
And the picture for USD/JPY looks even more pronounced, right? The divergence is wider there.
Oh, absolutely, Stark. The Fed is cutting, yeah, but its target range is still 3.34% to 4%. Meanwhile, the BoC is dug in at 0.5%. That's a massive interest rate gap, and it just creates relentless downward pressure on the Japanese yen. It doesn't really matter that Japan's inflation is currently 3%. The key takeaway is the BoC's patience. They're essentially okay with a weaker yen because their long-term forecast that inflation will fade, then return slowly to 2%, justifies keeping rates ultra low. As long as those two dissenters remain in the minority, that huge rate differential is going to keep the yen weak.
Okay, so to round out our summary, let's look ahead. What are the key events on the economic calendar we need to watch next week, based on everything we've discussed?
Right, the week ahead is pretty packed, but there's a critical overlay mentioned in the sources. The U.S. government shutdown is apparently affecting some official data releases. This means the market's going to be leaning even more heavily than usual on private sector surveys, which could make reactions even jumpier. So, key things to watch U.S. time. Monday, November 3rd, we get the S&P Global Manufacturing PMI for October. Tuesday, the 4th, brings the ISM Manufacturing PMI, always closely watched. Wednesday, the 5th, is big for jobs data. JOLTS's job openings for September, the ADP private payrolls estimate for October, and then the ISM non-manufacturing PMI. And then Thursday, the 6th, attention shifts overseas to the Bank of England's rate decision. But definitely keep an eye on those ISM and ADP numbers in the US. They'll likely carry extra weight this time. So if we synthesize the whole week, the picture is really one of fragmentation. Global policy is not moving in lockstep at all. You've got the U.S. clearly prioritizing downside employment risks now. Canada is battling these structural trade issues. And then Europe and Japan are both still anchored by worries about sticky domestic inflation. It feels like everyone's rowing in slightly different directions.
Yeah, the tension is really palpable. Central banks are reacting to their assessment of risks, the Fed on jobs, the ECB on external factors calming down. But the underlying data, like those depressed consumer expectations or tariff effects, still looks pretty challenging. Clarity isn't really there yet, is it? It feels very, very data dependent. We'll definitely need to watch the Fed's commentary around employment going forward and what the BoC sees in next year's wage negotiations in Japan. Those seem like the next potential inflection points.
You know, one thing that really stands out from the sources is this recurring theme of massive AI investment driving the U.S. economy, but simultaneously the Fed flagging these stretched equity valuations as a risk.
Zooming out, what does this tell us about central banks trying to manage this kind of technological wave? Is this the big new challenge, managing the financial stability risks that come with a potentially huge productivity boom that also creates, well, maybe irrational exuberance in markets? Is that the biggest unknown for policymakers now?